Last week was the worst week since March of 2023. That's a year and a half ago. The S&P was down 4.2% last week. The tech-heavy NASDAQ, 5.37%. The Dow, only 2.88%. And the Russell 2000, 5.6%. Mo, were you in the corner crying like a little baby like I was?
Yes.
Yeah, I'm kidding. Neither of us were. Yeah. We obviously like red days. We want to change that mindset for the people who watch our channel. We look at red days as the things we love going on sale. The question is the discount big enough? As I always tell the example, if my house is worth $1 million and I ask $5 million for it, nobody buys it. I discount it to $2 million. It's a 60% off sale, right? Mm-hmm. Yeah, it is, but it's still double the actual value. Don't get caught up in believing that just because something is down, it makes it a good price. Is it a great place to start? Absolutely. I'd rather start with stocks hitting 52-week lows than the other way around. And on our main channel, we have a great series of videos where we talk about 52-week low stocks. That way we can start looking for value there. Mo, in our main channel, we're releasing a video where we talk about July 10th was the peak of the NASDAQ so far. Okay. Whether we're on our way up to new highs or whatever, we have no idea. And anybody who says otherwise is an absolute liar. But you look at the Mag 7, first off, the S&P since July 10th, the NASDAQ's down 10.4%, S&P is down 3.5%. Then the NASDAQ 100. Yeah. Then you look at the Mag 7, Apple and Google, Apple and Meta are only down like 3 to 4 or 5%.
What about the rest?
13, 14, 20, 22%. Wow. And the worst one, guess which one? NVIDIA. Wow. Guys, we talk about this all the time. The most high-flying will fall the worst during the bear markets. If you look at the history of the NASDAQ, if you look at it from the peak of the 2000 bubble to now, it's pretty much I think it was the same returns as the S&P, but if you look at it from the lows of the bear market in 2003, it absolutely smokes the S&P. So I think the NASDAQ and the QQQ is a great place to dollar cost average into an ETF when valuations make sense. Mm-hmm. And it's a great place to get exposure to high ROIC, fast growing companies without picking them all the time.
Yeah, it's mostly tech.
It's tech heavy. It's tech heavy. Yeah. And tech companies are really great about high margin and really compounding that money. And even better, they have very low debt.
That's true.
And this week's a big week for earnings. Oracle's coming out, GameStop, a couple of banks here. Big Lots. Mo, Big Lots is on the verge of bankruptcy. Have you heard this?
Yeah.
It's amazing, isn't it?
Yeah. The one I'm most interested in is Kroger.
Kroger?
Yeah.
Tell us why.
I mean, think about it. Groceries. Yeah. People are going, what are they cutting their grocery spending at places like Kroger and going to a Walmart? We've seen Walmart is doing really well. Yeah, so Walmart same-store sales skyrocketing, but you see places like Target, Lowe's, Home Depot, same-store sales are plummeting. Yeah. Why? They're considered a little bit more, not luxury, but more of a non-essential thing you need. Also interested to see RH, because that is a luxury item. Restoration Hardware, yep. Luxury item. Are people still buying $15,000, $20,000 couches? Yeah. And of course, Adobe. Yep. Adobe, I think one of the best software businesses out there, second to Microsoft. High gross margins, high return on invested capital, subscriber business model. They make the best everything. Mo, what's your face looking at? Another interesting one is Dave & Buster's. Oh, where's Dave? Oh, Dave & Buster's on Tuesday under GameStop. Oh, right there. You're right. I didn't even see that. Like, those are the things I like to see. Like, how is the economy doing? We hear all these numbers all the time, but this is one where that's the first thing you're going to cut back on. Yeah. So if you're a consumer or Mo, are they going to do better because instead of people traveling, they're going to spend more money there than travel? Because consumer is 68 to 70% of GDP spend. So you have to sit there and say, where are the consumers putting their money? They still want to spend money. Yeah. Don't forget that. Still want to have fun. They still want to have fun. They're just going to change where they have fun. Are they going to go on the multi-$1,000 cruise, or are they going to stay at home and go to Dave & Buster's every so often and save some money? Or are they going to stop going to Dave & Buster's and go to the local park and do something else with their family? Yeah. I don't know. Right. But remember, our outlook is long-term. We don't care about what's going on in the short run. Do we still like looking at it? Of course we do. I love looking at what's going on in the economy. I love these talks about rates. What's the CME group now saying about rate cuts? It's crazy. 71% chance that there's a 25 basis point cut coming at the September 18th meeting, and a 29% chance at a 50 basis point cut. Basically, they're saying that they're going to cut rates. 100% chance that they're going to cut rates. It's just 25 basis points or 50 basis points. The question is this, guys, we've talked about this for a long time. When we sat there and said,
We now see data showing that the economy is probably not as strong as everybody thought. And I'm not saying because we don't care. We don't sit there and say like, this is right. We've been wrong many, many times. But we always said, why would the Fed cut rates? You don't cut rates just because the people want it. You cut rates because the economy needs it. We have a video recently where we showed the cutting of rates and recessions. And it's literally basically apart from two different times in history, it's about the same time. Go ahead, Mo.
The jobs number came out last Friday.
Of course.
That was something big. So this is from the Bureau of Labor Statistics, showed that the labor market added 142,000 non-farm payroll jobs in August, fewer additions than the expected 165,000. Unemployment fell to 4.2% from 4.3%. And there was an August revision. It came in that 89,000 jobs added in July, fewer than the expectation. So
where jobs go, jobs are a lagging indicator, guys. You look at this and going, okay, why are people laying them off, etc. We're here to teach a process that doesn't care about what's going on in the short run. You know, it's so funny. We get a lot of questions. Paul, what do you think is going to happen to stocks if rates go up? If oil goes, I don't know / don't care. We would have thought that with rates going from 0 to 5.25%, stocks would collapse, home prices would have collapsed, and the exact opposite occurred, right? You don't know what's going to happen. That's why the process of picking great companies and looking for opportunities to buy them is what we're trying to focus on here. And don't worry, guys. I was in the same boat before. I used to always worry, what's going on with stocks? What's going on? Oh my God, what's happening here? I don't care anymore. And guess what? Life's been easier since. It's more enjoyable. You sit there and just go, oh, cool. I loved Microsoft at 300. Now it's at 200. Let me go buy some more. Oh, it went to 150. Even better buy. We're trying to teach that. We're not trying to teach that the market's short-term fluctuations mean that you are wrong or right. You look at NVIDIA. Think about this. NVIDIA is 23% cheaper than it was back on July 10th. 23%. Does that even make sense? The company's revenue and profit's still going up. You look at Amazon. Amazon's flat for the last 3.5 years, essentially. Flat or down, actually. And yet its revenue and profit is up so much more. Look at Tesla. Tesla's all-time high of $415 per share. It is now at like $215 or $220, got as low as $100. But guess what? Revenue's up 100%, profit's up over 100%. Come on, guys. That's in the short run, stocks are a voting machine. In the long run, they're a weighing machine. Behind me, we have our stock to GDP ratio. Last week, it was at 109%, overvalued. Today, 100.88% overvalued, okay? Again, people have criticisms of the stock market GDP ratio. Warren Buffett considers it the single most reliable indicator, and it makes sense. As the U.S. economy gets bigger and bigger, the stock market should account for a certain percentage. Based on history, we're 100% overvalued. Fair value is around 2,700, okay? Now, for those of you who just care about profit, I don't blame you. The 10-year cyclically adjusted PE ratio is 103% overvalued. Guys, let's look back at the 2000 tech bubble. The 2000 tech bubble, going all the way back to 2000, it got 150% overvalued. The next 10 years, look at all these negative numbers. These are the next 10-year returns, all negative. Now, is it going to play out the same way here? I don't know. All I do know is, what I do feel is that the next five or 10 years are not going to be as good as the last 5 or 10 years. We had so many things that happened. Eventually, every investment has to be the present value of all its future cash flows. The more you pay, the less your return's going to be. That's just math, guys. There's no way around that. Mo, go ahead.
Talking about NVIDIA. So I'm just looking for stuff here on Yahoo Finance, and these are 3 interesting stories. Listen to how the sentiment has changed on NVIDIA. These are titles. Billionaires are selling NVIDIA stock, buying this index that could soar 34%, 40-some%. NVIDIA's dominance could be ending, Citi says. Go a little further here. There's one more. NVIDIA tries to rebound after severe pullback. Like, this, you couldn't go wrong with this a couple of weeks ago. And now it's over?
Yeah.
Things changed that quick?
Yeah.
On this monster company? It's really funny. It's really funny.
Guys, there's no denying NVIDIA is a great company. There's no denying, of all the Mag 7 companies, I think they're all incredible businesses. But I want you to differentiate stock from company. I recently bought a Cybertruck. It's getting wrapped as we speak.
Nice.
Yet I'm not buying Tesla as a stock. I love that Cybertruck. You've got to differentiate the two, guys. If you don't do that, you're going to end up buying things you love, which are probably things that everybody else loves. And then when the stock goes down, what's going to happen? You have to understand that you're buying a future set of cash flows. Guys, If you enjoy this channel, if you like hearing videos 4 or 5 times a week like this, subscribe to the channel. I appreciate your time.